You're listening to Capital Topics, episode number 67. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François, Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll review the findings from a research report from Dr. Hendrik Bessembinder, published in July 2024, entitled, Which U.S. Stocks Generated the Highest Long-Term Returns? Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm fine, thank you. And how are you?
I'm very good, thank you. So we're back after a short summer break. I hope our listeners also have enjoyed some time off over the summer. So I will start this off. We believe our listeners will find today's topic very insightful. The mantra about stocks is that in the long run, you will make money despite the volatility in the short term. What gets lost in translation about this fundamental investing belief is that it only really applies to buying the market. Our regular listeners know we preach broad market ETF as optimal for most individual investors. So it was interesting to see research that strongly support this investing strategy. This summer, an academic financial economist we follow, Dr. Hendrik Bessembinder, who is a professor at Arizona State University W.P. Carey School of Business, published a paper that makes the case that owning individual stock in a portfolio has a high probability of a negative outcome. James, why don't you report on Professor Bessembinder's findings?
Well, thank you for that introduction, François. This latest study really challenges our long-held belief about stocks. Most investors know the mantra that the stock market has delivered solid results over time. Stocks are for the long run, the famous book by Jeremy Siegel. In his July 2024 paper, Which U.S. Stocks Generated the Highest Long-Term Returns, Professor Bessembinder analyzed the returns of 29,078 publicly listed common stocks in the U.S. stock market. And they were, this data came from the CRSP database, which is an acronym for the Center for Research and Security Prices, that's based out of the University of Chicago. And it covered the period from 1926 to 2023, so almost 100 years. Mm-hmm. His key findings, François, are, first, on average, companies appeared in the CRSP database for only 11.6 years. The median...
That's a short time span, 11.6 years.
Well, get ready for the second one. The median lifespan of a public company was just 6.8 years. Only 31 stocks were present in the database over the full 98-year period. The majority, specifically 51.6%, had negative cumulative returns, and most stocks, in fact, destroyed value.
No.
The median outcome was a return of negative 7.41 per annum. Now, the next finding is a little bit wonky. It's a lot of jargon. The mean compound return outcome was strongly positive, while the median outcome was negative. Results from the positive skewness in the distribution of compound stock returns. Again, like I said, it's a lot of technical jargon.
A lot of jargon here.
Yeah. What he means is that the best performing stocks are what creates the positive compound return for the markets. So even when he restricted the data to include those stocks that had at least 5 years of history, but not more than 20, it resulted in the majority producing negative returns. Even among the 30 stocks with the highest cumulative compound returns, the results were relatively modest. The median annualized return across the 30 stocks was 13.03%, while the mean was 13.05%, and the largest return was Altria Group at 16.29%. Well, some of our listeners may wonder, who's Altria? Well, that's really the company that came as a result of a name change. It used to be called Philip Morris, which is the maker of Marlboro cigarettes.
Yeah, Marlboro Man.
So this finding is understandable, in my opinion, because again, you're dealing with compound rates, and it's like interest on interest or return on return. So it's understandable that those returns are lower, but not if you've got a stock that's been in there for 98 years, compounding at 13%, then it's a really big number at the end of the 98 years.
Yeah, I believe these findings will come as a surprise for most investors. The fact that the majority, 51.6% of stocks, have negative cumulative returns is very astounding to me. But given how well the broad U.S. market has performed over this period of almost 100 years, I believe we must assume that the negative or mediocre performance results of most stocks are overshadowed by the high returns from the very few big winners.
Well, let me quote from Bessembinder to support your argument, François. Slightly more than 4% of the stocks that have been publicly listed in the U.S. since 1926 are responsible for all of the net wealth enhancement to shareholders.
Wow.
That is, long-run wealth enhancement in the public stock market is concentrated in relatively few stocks.
What are some of the other surprises that come out of this study, James?
Well, François, another surprise was that many stocks don't stay in the public markets all that long. Like we mentioned a little earlier, on average, stocks trade for an average of 11.6 years, while the median or midpoint tenure is even lower at 6.8 years. Of the 29,078 stocks analyzed, only 31 made it through all 98 years from December 25th to the end of 2023. So there's a big survivorship issue with publicly traded companies. Companies can often get delisted from the stock exchange or kicked off simply owing to poor performance or non-compliance on governance issues, or they get merged or acquired out of existence.
Mm-hmm. Since only 4% of the stock generate all the wealth, what does Professor Bessembinder say about passive investing in all of this?
Well, that's a great question, François. Bessembinder's latest study does not specifically discuss indexing. That said, his previous research gives a nod to this investing approach. In addition, in a recent podcast about this paper with Meb Faber in the US, he confirmed that he invests passively for himself. The latest study builds on this earlier research that also revealed that most of the market returns came from a small number of great performing stocks. Bessembinder published a study in 2020 titled Wealth Creation in the U.S. Public Stock Markets from 1926 to 2019. In this study, he analyzed the long-run stock market outcomes in terms of the increases or decreases in shareholder wealth creation relative to a treasury bill a benchmark, again, in the U.S. markets. He actually was the one who introduced this concept of shareholder wealth creation that takes into consideration the full history of both net cash distributions and capital appreciation.
What's the main takeaway from the 2020 study, James?
Well, to me, François, it is that 86 top performing stocks, which represents less than 1/3 of 1% of the total stocks in the study, collectively accounted for more than half the wealth creation. And the top 1,000 performance stocks, less than 4% of the total stocks, accounted for all the wealth creation. So the other 96% of stocks just matched the return of riskless 1-month treasury bills. So again, it's this current study in 2024 is just an offshoot of that 2020 study.
Yeah.
He's basically saying, François, that the big winners are not easy to spot, except in hindsight. And I have a quote from him. The only way to be certain of owning the stocks that turn out to be the future big gainers is to own all of them. So, we know that's our mantra, broad-based ETFs to capture the returns of those big stocks.
Yeah. Our listeners know that we also believe stock picking is very difficult, even for professionals. I think it's fair to say that this latest research supports our belief that passive investing is the only reliable way for most investors to generate high returns. What else can you add, James, to this report?
Well, I'm going to quote our good friend Larry Swedroe. Again, we've quoted him often in our podcast, and he's written many, many books. He reviewed this study recently, and I quote from an article he published in Financial Advisor magazine online. Since the historical record indicates that it is likely that the net wealth creation destruction attributable to the overall stock market in the future will be concentrated in relatively few firms, and that active management is unlikely to benefit from that concentration, the winning strategy is to avoid active security selection and/or market timing.
I completely agree with what Larry is saying. On the one hand, yes, the market currently is concentrated with the Magnificent Seven, but you cannot guess what the future high-performing stocks are going to be. Your best bet is to remain broadly diversified so that you will own them all. Another way to say this is that buying the stock market has a positive expected return, but buying individual stock does not. In conclusion, James, what can we say are the main takeaways for listeners?
Well, our listeners should take away that it is highly unlikely they will have a positive outcome by investing in individual stocks. The Magnificent Seven stocks' recent massive outperformance is really tempting for investors to try and follow and replicate, but this exceptional outperformance is really only evident with hindsight. So again, I'll go back to Larry Swedroe for a quote and really to summarize. Investors make mistakes when they take idiosyncratic, diversifiable, uncompensated risks. They do so because they are overconfident of their skills. They overestimate the worth of the information they have on hand. They confuse the familiar with the safe. They have the illusion of being in control, and they don't understand how many individual stocks are needed to effectively reduce diversifiable risks. And they don't understand the difference between compensated and uncompensated risks. And again, I think it's very well said, François. Larry is basically telling the readers that you're very unlikely to have the skill to pick these super performing stocks.
Mm-hmm. I would add, James, that by adopting the passive broad market ETFs, you're most likely to benefit from the modest differences in annual returns that lead to large differences in cumulative returns. Let the magic of compounding work for you. So that's it. Thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
That's it for episode 67 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for next episode to be released on October 23rd. In the meantime, make sure to consult Capital Topics website and our latest blogs. See you soon.